What if the biggest opportunity in the precious metals market is unfolding right in front of you, while most investors are looking the other way? The analyst who accurately called silver at 56 has just released a new warning, and this one could have even greater consequences. The signals building across the global economy, the supply chain, and the financial system suggest that silver may be approaching another defining moment. In this video, we'll examine what this warning means, why experienced investors are paying close attention, and the critical factors that could shape the next major move in silver. The analyst who once called silver reaching the $56 level has issued another warning, and naturally that has captured the attention of investors across the world. Whenever someone with a proven track record speaks about the precious metals market, people begin asking whether history is about to repeat itself. Markets are driven by expectations, emotions, and changing economic conditions, but they are also influenced by individuals who have demonstrated an ability to recognize important trends before they become obvious to everyone else. That is why this latest warning deserves careful attention, not because any single analyst can predict the future with certainty, but because experienced market observers often identify developing risks and opportunities long before they appear in the headlines. Silver has always been one of the most misunderstood assets in the financial world. Unlike many traditional investments, it occupies a unique position because it serves both as a monetary metal and as an industrial commodity. During periods of economic uncertainty, investors often seek silver as a store of value alongside gold. At the same time, industries depend on silver for electronics, solar panels, medical equipment, electric vehicles, advanced technologies, and numerous manufacturing processes. This combination creates market dynamics that can become extremely powerful whenever investment demand and industrial demand begin increasing simultaneously. The latest warning focuses on a growing disconnect between what many investors believe is happening and what may actually be developing beneath the surface. Financial markets often appear calm until pressure builds to a level where sudden movements become unavoidable. History repeatedly shows that the biggest price moves usually begin before the average investor realizes conditions have changed. By the time mainstream discussions acknowledge a trend, much of the opportunity has already passed. One of the reasons experienced analysts continue watching silver closely is because market sentiment often swings to extremes. There are periods when enthusiasm becomes excessive, pushing prices higher than fundamentals justify. There are also periods when fear dominates, causing investors to overlook strong long-term conditions. These emotional cycles create opportunities for those willing to analyze facts rather than simply follow public opinion. Recent economic developments have created an environment filled with uncertainty. Inflation has remained a concern in many parts of the world, despite aggressive monetary tightening by central banks. Interest rates have risen dramatically compared to previous years. Borrowing costs have increased, and many economies continue facing slower growth. Investors are trying to determine whether inflation will remain persistent, whether recession risks will increase, or whether policymakers will eventually reverse course. These uncertainties matter because precious metals often perform differently depending on investor expectations. If confidence in paper currencies weakens, interest in tangible assets can rise rapidly. Silver has historically benefited whenever people begin searching for alternatives that cannot be created through monetary policy decisions. The warning also reflects concern about how quickly financial conditions can change. Markets often spend long periods moving sideways before entering explosive trends. During these quiet phases, many participants lose interest because prices appear stagnant. Yet experienced investors understand that consolidation frequently precedes significant movement. The absence of excitement does not necessarily indicate the absence of opportunity. Looking back through financial history, silver has demonstrated remarkable volatility. It has experienced dramatic rallies followed by equally sharp corrections. These fluctuations discourage short-term traders while attracting long-term investors who recognize that volatility often accompanies assets with limited supply and growing demand. Understanding this characteristic is essential because large price swings should never come as a surprise in the silver market. Many people assume precious metals move only because of inflation, but reality is more complex. Currency strength, geopolitical tensions, industrial production, investor psychology, interest rates, mining output, government policies, and technological innovation all contribute to silver's price behavior. The interaction of these factors creates an environment where rapid changes can occur once market expectations shift. Another reason the analyst warning has generated attention is the increasing complexity of global financial markets. Today, information travels instantly across continents, capital moves rapidly between asset classes, and geopolitical events influence markets within minutes. This interconnected environment means that developments in one region can quickly affect investor sentiment worldwide. Confidence plays a central role in every financial system. Modern economies rely heavily on trust in currencies, institutions, governments, and financial markets. Whenever confidence weakens, investors begin searching for assets they perceive as more stable over the long term. Precious metals have historically benefited during periods when confidence becomes uncertain, although past performance does not guarantee future results. The analyst emphasizes that successful investing rarely depends on reacting emotionally to breaking news. Instead, it requires understanding broader trends before they become obvious. This approach involves examining supply, demand, monetary policy, industrial usage, investor positioning, and macroeconomic conditions together rather than focusing on isolated headlines. Many investors make the mistake of assuming yesterday's market conditions will continue indefinitely. During bull markets, they expect prices to keep rising forever, while during difficult periods they believe weakness will never end. Financial history repeatedly demonstrates that markets are cyclical. Conditions evolve, narratives change, and assets previously ignored can suddenly become market leaders. Silver's relationship with gold also deserves attention. Although both metals often move in similar directions over long periods, silver typically experiences greater percentage gains and losses because its market is considerably smaller. Even relatively modest increases in investment demand can have a meaningful impact on price movements due to this smaller market size. Industrial demand continues expanding in several important sectors. The global transition toward renewable energy has increased attention on silver because of its exceptional electrical conductivity. Solar technology requires significant amounts of silver, while electric vehicles, advanced electronics, telecommunications infrastructure, and medical applications also contribute to long-term industrial consumption. Mining production presents another important variable. Increasing output is rarely simple. Developing new mining projects often requires years of exploration, environmental approvals, financing, infrastructure development, and construction before production begins. Even existing mines face challenges, including declining ore grades, higher operating costs, labor shortages, and geopolitical uncertainty. If industrial demand continues increasing while mining supply struggles to keep pace, market conditions could gradually tighten. Such changes rarely happen overnight. Instead, they develop slowly until inventory levels become increasingly important and buyers begin competing more aggressively for available metal. Investor behavior frequently amplifies these trends. During periods of weak sentiment, many individuals reduce exposure to precious metals, believing better opportunities exist elsewhere. Yet, if confidence shifts unexpectedly, demand can accelerate rapidly. Since silver markets are relatively small compared to global equity or bond markets, even modest reallocations of investment capital may produce significant price effects. The analyst's warning encourages investors to avoid focusing exclusively on daily price fluctuations. Short-term volatility often distracts from larger structural developments unfolding over months or years. Successful long-term investing generally requires patience, discipline, and an understanding that meaningful trends rarely develop in perfectly straight lines. Risk management remains equally important. No investment offers guaranteed returns, and silver is no exception. Prices can move unexpectedly due to changing economic data, policy announcements, geopolitical developments, or shifts in investor sentiment. Recognizing uncertainty allows investors to make more balanced decisions rather than assuming any single outcome is inevitable. One of the greatest challenges facing investors today is information overload. Every day brings countless predictions, opinions, and conflicting narratives. Some experts forecast extraordinary gains, while others anticipate significant declines. Distinguishing between speculation and evidence requires careful analysis rather than emotional reactions. Experienced analysts typically focus on probabilities instead of certainties. They recognize that markets involve uncertainty, but they also understand that certain conditions historically increase the likelihood of specific outcomes. Their objective is not to predict every short-term movement, but to identify environments where risk and reward become increasingly favorable. Economic cycles further complicate market expectations. Periods of expansion eventually slow, slowdowns eventually recover, and financial conditions evolve continuously. Precious metals often respond differently depending on where economies stand within these broader cycles. Understanding these relationships helps investors interpret market developments more effectively. Inflation expectations remain another critical factor. Even if headline inflation declines, persistent concerns about purchasing power can continue influencing investor behavior. Many individuals view precious metals as a potential hedge against long-term currency depreciation, particularly when government debt levels remain elevated and fiscal pressures increase. Government debt has become an increasingly important discussion worldwide. Many countries continue carrying historically high debt burdens while simultaneously facing rising interest costs. Although governments possess numerous policy tools, investors carefully monitor how these financial obligations may influence future monetary and fiscal decisions. Currency markets also deserve attention. The strength or weakness of major currencies affects international commodity pricing because silver is typically traded globally in US dollars. Changes in exchange rates influence purchasing power, international demand, and investment flows across different regions. Market psychology frequently creates opportunities for disciplined investors. Fear encourages selling near market lows, while excitement encourages buying near market highs. Understanding these emotional tendencies helps investors remain focused on long-term fundamentals rather than short-term sentiment. The analyst's warning is less about predicting an exact price target and more about encouraging investors to recognize changing conditions before they become widely accepted. Financial markets reward preparation more often than reaction. Waiting for complete certainty usually means accepting reduced opportunity because markets tend to move ahead of public consensus. Institutional investors also monitor precious metals differently from retail participants. Large investment funds evaluate macroeconomic trends, portfolio diversification, inflation expectations, currency risks, and geopolitical developments when determining asset allocations. Even relatively small adjustments by institutional investors can influence market liquidity. Technology has transformed financial markets dramatically over recent decades. Algorithmic trading, exchange-traded products, high-frequency trading, and digital investment platforms have increased market efficiency while also contributing to faster reactions during periods of uncertainty. This technological evolution means price movements can accelerate more quickly than in previous generations. Historical perspective remains valuable because markets consistently demonstrate recurring behavioral patterns. Human emotions change very little even as technology advances. Optimism, fear, greed, caution, confidence, and uncertainty continue influencing investment decisions much as they always have. Another reason experienced analysts command attention is their willingness to challenge prevailing narratives. Consensus opinions often dominate financial discussions, but major market turning points frequently occur when consensus proves incorrect. Independent analysis becomes especially valuable during periods when widespread assumptions deserve closer examination. Ultimately, the warning invites investors to ask deeper questions rather than accept simple answers. What is happening beneath current market prices? How sustainable are existing economic conditions? Are supply and demand trends evolving in ways not yet reflected by market sentiment? Could changing monetary policies alter investor behavior more rapidly than expected? These are the kinds of questions experienced analysts continually examine, while others focus only on daily headlines and short-term price movements. One of the most significant concerns surrounding the silver market today is the growing discussion about supply. While price movements often dominate financial headlines, the real story frequently develops behind the scenes, where production, inventories, industrial demand, and long-term resource availability quietly shape the future of the market. Experienced analysts have spent years monitoring these underlying fundamentals because they understand that sustained shortages rarely appear overnight. Instead, they develop gradually, often unnoticed by the majority of investors until the effects become impossible to ignore. Silver is unlike many financial assets because it must first be mined before it can enter the global economy. Every ounce begins deep underground, requiring exploration, permitting, financing, extraction, refining, transportation, distribution before reaching manufacturers or investors. This entire process is expensive, time-consuming, and increasingly complex. Unlike paper assets that can be created electronically, physical silver depends entirely on the ability of mining companies to produce enough metal to satisfy growing global demand. Many people assume that if silver demand rises significantly, mining companies can simply increase production. In reality, mining does not work that way. Developing a new silver mine often takes many years from initial discovery to commercial production. Companies must identify economically viable deposits, conduct geological studies, secure environmental approvals, negotiate with governments, obtain financing, construct infrastructure, hire skilled workers, and build processing facilities. Every stage introduces uncertainty, delays, and rising costs. Even existing mines face serious challenges. Many of the world's richest silver deposits have already been developed over previous decades, leaving companies to operate lower-grade ore bodies that require processing more material to produce the same amount of silver. Lower ore grades increase energy consumption, equipment wear, labor requirements, and overall production costs. These operational realities make expanding supply increasingly difficult even during periods of favorable market prices. Another important factor is that much of the world's silver is not mined as a primary product. Instead, it is produced as a byproduct of mining operations focused on copper, lead, zinc, or gold. This creates a unique dynamic because silver production often depends on the economics of entirely different metals. If copper or zinc producers reduce operations due to weak market conditions, silver output may decline even if silver prices remain strong. This disconnect makes predicting future supply considerably more complicated than many investors realize. Global mining investment has also experienced periods of underinvestment. During years of lower commodity prices, many mining companies reduced exploration budgets to preserve cash and satisfy shareholders, demanding financial discipline. Exploration is essential because it identifies future reserves capable of replacing depleted mines. When exploration spending declines for extended periods, fewer major discoveries are made, increasing the likelihood of tighter supply in future years. Geological reality cannot be ignored either. Mineral deposits are finite resources. Every ounce extracted today reduces the amount remaining underground. While new discoveries continue occurring, major high-grade silver discoveries have become less frequent compared to previous generations. Easy deposits have largely been found, meaning companies must search deeper, explore more remote regions, and invest substantially greater resources simply to maintain current production levels. Environmental regulations have also become increasingly important across the mining industry. Governments and local communities now demand stricter environmental standards, greater transparency, improved waste management, and stronger protections for ecosystems and water resources. These requirements play an important role in responsible resource development, but they also extend project timelines and increase operational costs. Political uncertainty introduces another layer of complexity. Many significant silver-producing regions are located in countries where regulatory changes, taxation policies, labor disputes, or geopolitical developments can affect mining operations. Companies investing billions of dollars into long-term projects require confidence that legal frameworks will remain reasonably stable throughout the life of a mine. Sudden policy changes can delay expansion plans or discourage future investment. At the same time that supply faces growing constraints, industrial demand continues expanding across multiple sectors of the global economy. Silver possesses exceptional physical properties that make it extremely difficult to replace in many advanced technologies. It is the most electrically conductive metal known, making it invaluable in electronic circuits, high-performance connectors, semiconductors, telecommunications equipment, and renewable energy systems. The rapid growth of solar energy has become one of the strongest long-term demand drivers. Modern photovoltaic panels rely on silver to efficiently conduct electricity generated from sunlight. As governments and private industries continue investing heavily in renewable energy infrastructure, the amount of silver required for solar manufacturing has increased substantially. Although manufacturers continuously seek ways to reduce silver usage per panel, overall installation growth has generally offset these efficiency improvements. Electric vehicles represent another expanding source of industrial demand. Compared to conventional vehicles, electric vehicles require significantly more electronic components, sophisticated control systems, advanced sensors, charging technology, and power management equipment. Many of these systems depend on silver's superior conductivity and reliability. The global digital economy further reinforces silver consumption. Data centers, artificial intelligence infrastructure, telecommunications networks, cloud computing systems, consumer electronics, medical devices, aerospace technologies, and advanced defense equipment all require highly reliable electrical connections where silver often remains the preferred material. As technological innovation accelerates, demand from these industries may continue increasing regardless of broader economic cycles. Medical applications provide another important source of demand. Silver possesses natural antimicrobial properties that have made it valuable in wound care, surgical instruments, hospital equipment, specialized coatings, water purification technologies, and various healthcare products. Growing global populations and expanding healthcare systems support continued usage across these specialized markets. Unlike gold, which is primarily stored for investment and jewelry purposes, much of the silver used in industrial manufacturing becomes difficult or uneconomical to recover. Tiny quantities incorporated into electronics, medical equipment, batteries, industrial components, and countless consumer products often remain unrecycled because extraction costs exceed the value of the recoverable metal. Over time, this means significant amounts of silver effectively leave the available supply chain. Recycling certainly contributes meaningful volumes back into the market, but it has limitations. Recovering silver from complex electronic devices requires sophisticated processing facilities, substantial labor, and specialized technology. Economic incentives determine whether recycling becomes financially attractive. During periods of lower silver prices, some recycling activity declines because operating costs outweigh potential returns. Investment demand adds another layer of uncertainty. During stable economic periods, industrial consumption often dominates market attention. However, when inflation concerns rise, financial uncertainty increases, or geopolitical tensions escalate, investors frequently purchase physical silver coins, bars, and investment products in large quantities. Because the silver market is relatively small compared to global financial markets, even moderate increases in investment demand can significantly tighten available supplies. Retail investors have demonstrated this repeatedly during previous periods of economic stress. Coin dealers occasionally report shortages, delivery delays, and increased premiums above spot prices when physical demand rises unexpectedly. These situations illustrate the difference between quoted market prices and the practical availability of physical metal. Institutional investors also play a growing role through exchange, traded funds, and other investment vehicles backed by physical silver. Large inflows into these products can remove substantial quantities of metal from immediate circulation, reducing available